All right, now we are discussing the materiality, and we have already discussed this term in the first chapter when we were discussing the definition and the objective of the external audit. So an item is being called as material if that can affect the decision of the user of the financial statement. And who is the user of the financial statement? The shareholder. Let's assume I'm a billionaire and I lost 1,000 rupees or $1,000. Let's assume I'm a billionaire in terms of dollars, and I lost $1,000. Now, I'm a billionaire and I lost $1,000. Maybe these $1,000 are not material for me. I say, okay, let's move on. Okay, now I cannot find those things. Let's not waste time on those things. Now, what if a person who is having $10,000 and lost 10,000 out of it? Obviously, that amount is going to be material for that guy because he was only having the $10,000. So materiality is different for everyone. And when you talk about the companies, materiality is even different for every company. You know, the size of the company is different. Like there are companies which are small companies, small and medium term enterprises, large entities, listed entities, single entities, group of companies. So the materiality is different for every company. Similarly, the nature of the entities are different. Some operations are very easier, simple, and some operations are really complex. Then you talk about the system. Some systems are very strong, some systems are weak. The level of audit risk, that means the chances of the financial statement being materially misstated. In some cases it is high, in some cases it is low. So these are the factors, etc. These are the factors which affect the materiality. Materiality is not going to be the same for every company. It is going to be different because the size may be different, the nature may be different, the system may be different, the level of audit risk may be different. So it is different for every entity. Now, who is going to decide a materiality level? Who is going to decide this materiality level? Obviously, the auditor is going to decide this materiality level. So you can say the materiality is a matter of the auditor's professional judgment. So let's assume I'm doing an audit of a client. I'll be looking at their system, at the size of the company, their nature of the operations, the level of the audit risk over there. And then I'll be deciding a figure according to my judgment that, okay, this amount and more than this is going to be material. Let's assume $400,000. An example, $400,000 and more are going to be material. Now, this is according to me, this is according to my judgment, based on the size, nature, system, and the level of the audit risk. Now, maybe for another entity, it is $600,000. Maybe for another entity, it is $800,000. But being an auditor, I am going to decide the materiality level according to every company, considering different points, considering different factors, which are written right in front of you. So materiality is a matter of the auditor's professional judgment. Now, there are two types of materiality: quantitative materiality and qualitative materiality. So when you are looking at the amounts and figures, that is known as the quantitative materiality. Quantitative. And when you are looking at the nature of the transaction rather than the numbers, that is known as the qualitative materiality. Now, I told you, like I decided a level being an auditor, 400,000 and more is going to be material. Now, when I'm looking at the materiality in terms of figures and in terms of numbers, then that is known as the quantitative materiality. And where I am ignoring the numbers and the amounts, and instead I am looking at the nature of the transaction, that is known as the qualitative materiality. For example, director remuneration should be separately disclosed. This is what we studied in the chapter number 1. Now, irrespective of the amount, the director remuneration should be separately disclosed. So if I am looking at the nature of the transactions rather than numbers. This is qualitative materiality. Another example may be from your F7 exam, related party transactions or intra-group transactions. The transaction within the group should be separately disclosed, or the intra-group transaction should be eliminated, irrespective of the amount. Now, when we are looking at these type of transactions, that is the qualitative materiality, where the figures and amounts does not matter and the nature of that transaction matters a lot. Now, the question is, do we have any benchmark? Do we have any threshold for the quantitative materiality? Yes, we do have a benchmark, we do have the threshold, but that is not defined. By any standard. It's actually a generally accepted benchmark. It's a generally accepted benchmark. Or you can call it the threshold, whatever it is. Profit, asset, and revenue. 5% or more is going to be material. 1% or more is going to be material. 0.5% or more is going to be material. Now, let's assume you are auditing a client and their inventory is not recorded at lower of cost or NRV. Now, this is a material misstatement. This is a misstatement. Now we have to see whether this is a material misstatement. This is a misstatement. This is not according to the standard, that their inventory is not recorded according to the IS2. It should be recorded at lower of cost and NRV. Okay, now you have to see. Let's assume damaged inventory. There is a damaged inventory of $1 million, which should be written down to its NRV, or it should be completely written down, but the management has still recorded it at cost. The total profit before tax of the entity is, let's assume, 10 million. Now I need to see whether this misstatement is a material misstatement or not. So I will be comparing this 1 million with the total profit of 10 million. So it is going to be 10%, 10% of profit before tax, which is more than 5%, which is a benchmark for the profit. So we are going to say this is a material misstatement. So when we see the materiality in terms of the quantity, in terms of the amounts, in terms of the figures, then that is known as the quantitative materiality. And when we see the nature of the transactions rather than the figures and amounts, that is known as the qualitative materiality. Okay, there are a few things further you need to understand, and this line, which are last two lines, are very important. Higher the risk, the lower the overall materiality. Now, I told you in the audit strategy thing that when we are at the planning stage, we determine a materiality level, which is known as the initial materiality level or preliminary materiality level. And when the audit progresses, you can change it. For example, this 400,000 was the materiality level, initial materiality level. And when you were doing the testing, you realized that the system of this entity is quite weak. And there are more chances that the financial statements may be materially misstated. So this was the initial materiality level. And when the audit progressed and I moved toward the system testing, being an auditor, I realized that this system is quite weak. And as a result, I have to change my materiality level. Now, am I going to increase this or decrease this level? So the answer is that I am going to decrease this. I'll bring it to, for example, let's assume $300,000. Now, what is the logic behind that? When the system was weak, when the audit risk was high, that there were more chances that the financial statements may be materially misstated. Why I'm decreasing the materiality level? The reason is because now I need to perform more testing. Now I need to check more figures. More figures should come to my testing. More figures should fall in my testing. That is why I am decreasing the materiality level. Initially, it was 400,000. Initially, I said $400,000 and more will be material. Now I have to test more. So I will be decreasing my materiality level. So that is written over here. Higher the risk, the lower the overall materiality. So there are a few things we have studied in this slide, which is very, very important. And you have to, again, learn this slide and the next one as well, which is performance materiality, because examiner usually ask it, what is materiality and performance materiality. So far what we have discussed is that an item is material if it can affect the decision of the user of the financial statements. Now, determining the materiality is a matter of the auditor's judgment. Auditor will be looking at certain factors like size, nature, system, level of audit risk, and based on that, the auditor will be deciding the initial materiality level. And that may be changed further when the audit progresses. If auditor realize that there is a high level of audit risk, the system is weak, whatever. And there are two types of materiality: qualitative materiality and quantitative. So qualitative is when we see the nature of the transactions rather than numbers and figures. And when we see the numbers and figures amounts, that is known as the quantitative materiality. Both are the materiality thing. And when we are giving the opinion, the last stage of the audit, when we are drafting the report, we are not concerned if there are misstatements. We are concerned if there are material misstatements. So in order to determine the materiality, we should keep the quantitative as well as qualitative guidances in our mind. All right, now we will be discussing the performance materiality. And again, in order to understand this concept, I am going to give you an example. Let's assume I have decided, being an auditor, the initial materiality level, and let's assume it is $300,000. Now, in my view, $300,000 and more is going to be considered material. Let's assume they have not charged an impairment of 350,000. Now, because it is more than 300,000, I'll be saying it is material misstatement. Now, it's fine that we know a figure and that will be used for determining whether an amount is material or not. We'll also be giving this command to the system, and we'll be telling the system that, okay, you have to see every transaction which is 300,000 or more. But even the management knows our strategy and plan, because we have been doing their audit for many years, because they were the auditor as well previously. So they know that how we perform the audit and what are the sample sizes, what are the materiality levels usually we decide. So they may maneuver, they may manipulate the financial statements, keeping these things in our mind. Because we have given a command to the system that 300,000 or more is material. Now, what about even 2,99,999? The system is going to say this amount as immaterial because it is less than 300,000. Now, what if there are 50 misstatements of similar amount? Individually, they are not material because they are less than 300,000. But when you aggregate them, it's a huge misstatement. It's a material misstatement affecting the overall financial statements. So in order to detect those misstatements which are not material individually, but they can be material in aggregation with other misstatements, we use a concept of materiality which is known as the performance materiality. So the performance materiality says that when the auditor is doing the testing, practically the auditor should reduce the materiality level. They should reduce the materiality level, and the materiality level should be less than the initial materiality level or overall materiality level. Let's assume my overall materiality level is 300,000. I should bring it down to 2,50,000, let's assume. In order to detect those misstatements which are not individual, which are not material, sorry, individually, but they are material in aggregation. So this is the concept of the performance materiality. In assessing materiality, the auditor must consider that the number of errors, each with a low value, may, when aggregated, amount to a material misstatement. Individually, some balances may not be material, but when they're aggregated, they may become a material misstatement. So in order to detect those misstatements, which are not material individually, but they are material in aggregation, the auditor reduces the overall materiality level, and that concept is known as the performance materiality. So in calculating materiality, the auditor should also set the performance materiality level. Performance materiality is normally set a level lower than overall materiality. It is used for testing individual transactions, account balances, and disclosures. The aim of the performance materiality is to reduce the risk that the total of the error in balances, transaction, disclosure does not in total exceed the overall materiality. So we'll be looking at the individual balances, which may not be material individually, but when you aggregate them, these misstatements may become a material misstatement. All right, now we have two more important topics. The first one is auditor responsibility in relation to the detection and prevention of fraud. And the other one is going to be auditor responsibility in relation to the detection and prevention of non-compliance with the laws and regulations. Now, we discussed in the chapter number 1 that the auditor responsibility is to provide the reasonable assurance regarding the financial statement, whether they are free from material misstatement, whether due to fraud or error, and they are prepared in all material respects and in accordance with the applicable financial reporting framework. So as the objective of the external audit suggests, that we are just there to give the assurance regarding the truth and fairness of the financial statements. We are not there to give the assurance on their internal control system. We are not going to give the assurance that there is no fraud involved within their financial statements. We are not there to detect and prevent the fraud. We are just there to comment on the truth and fairness of the financial statements. But when we say that the financial statements are free from material misstatement, whether due to fraud or error. So if the fraud is part of the financial statement as a material misstatement, this simply means fraud constitutes a material misstatement in the financial statement, then obviously it comes under the responsibility of the auditor. But when you talk about solely the detection and prevention of fraud, it is not the responsibility of the auditor, it is the responsibility of the management. So the external auditor is primarily responsible for the audit opinion on the financial statements following the international accounting standards. And I've given you the reference of the objective of the external audit, that we are there to comment on the truth and fairness of the financial statements, whether they are free from material misstatement, whether due to fraud or error, and they are prepared in accordance with the applicable financial reporting framework. We are not there to detect and prevent fraud, because we are not doing the forensic audit, forensic investigations, fraud identification. No, we are doing the external audit. So the main focus of the audit work is therefore to ensure that the financial statements show a true and fair view. The detection of fraud is therefore not the main focus of the external auditor's work. An auditor is responsible for obtaining reasonable assurance that the financial statements are as a whole are free from material misstatement, whether caused by the fraud or error. And I told you that if the fraud constitutes a material misstatement in the financial statement, then it comes under the responsibility of the auditor, but solely to detect and prevent fraud is the responsibility of the management. But the auditor should maintain an attitude of professional skepticism. That means the auditor should remain alert regarding two things. The first thing the auditor should bear in mind that the management can, or you can say management may override the controls. It is a possibility that the management can override the controls, could override the controls, may override the controls. Because of, like, for example, if you're too much believing on the integrity of the management and you're not being skeptical and you're not being alert, you're not having an investigative approach, critical mind, then obviously nothing will be coming in your attention. As a result, you may give the incorrect audit opinion. So by having less professional skepticism, the risk of the audit is increased. The audit risk is increased. So the first thing the auditor should bear in their mind is that the management may override the controls. And the second thing is that the procedures that the auditor has applied to detect the errors may not be effective for the detection of fraud. Like, simply I'm saying the procedure that the auditor is applying for the detection of errors may not be effective in the detection of fraud. That means you have to perform more procedures in order to see whether there is a fraud in the form of material misstatement in the financial statements. So the first thing you need to see is the materiality, that the auditor should keep in their mind that the term of the materiality, that an item is material if it can affect the decision of the user of the financial statement. The second thing is that the auditor should have a detailed discussion with the audit team at the inception of the audit, at the planning stage, that look, these are the areas where there may be a material misstatement, where there may be significant errors, where there may be frauds. So sometimes there are areas which are risky. So tell everyone within the audit team that you have to be skeptical within these areas specifically, especially. And the third thing is that if you have detected a fraud in one area, one section, one head of the financial statements, then you have to increase your testing in the other sections of the financial statement, because there is a possibility that other sections may include the fraud as well. So these are the things you need to keep in your mind regarding the fraud, that external auditor has no responsibility in relation to the detection and prevention of fraud. It is the responsibility of the management. But if the fraud constitutes a material misstatement, then obviously it comes under the responsibility of the auditor, and they should remain skeptical throughout the audit in order to see those things within the financial statements. Now we have a laws and regulations similar to the fraud. The auditor has no responsibility in relation to the detection and prevention of non-compliance with the laws and regulation. When you talk about the laws and regulation, there are many things the entity needs to comply. They may have to comply with the environmental laws and regulation, labor laws and regulations, labor laws, data protection laws. It can be anything. So if they are not complying with those laws and regulations, it is not our responsibility to detect and prevent the non-compliance. It is the responsibility of the management to ensure they are complying with the laws and regulation. But obviously, exception does exist. There are two exceptions. The auditor responsibility differ in two ways. The first exception, where the non-compliance constitutes a material misstatement. Let me give you a plain example first from your F7 knowledge, then you will be able to get the concept. For example, the government has given an entity a grant, and we know that there are certain conditions attached to the grant. Now the entity is not complying with the conditions attached to the grant. Generally, it is not a responsibility to see the non-compliance. But in this case, non-compliance will constitute a material misstatement. How? If they are not complying, the grants become repayable immediately, and the provision should be recognized for repayment. So if they are not complying, they should record a provision for repayment. And if the provision is not created, then this is a material misstatement within the financial statements. So in this case, we can see that this non-compliance constitutes a material misstatement within the financial statement. Another example may be not complying with the tax laws. That if they are not complying with the tax laws and they are doing the tax evasion, now the figures they have recorded within the financial statements regarding the tax payable, the tax expense may be materially misstated. So if the non-compliance constitutes a material misstatement, then it comes under the responsibility of the auditor to check whether there is a non-compliance affecting the financial statements. And the second thing is that the non-compliance does not constitute a material misstatement directly within the financial statement, but it can affect the trading ability of the organization. By not complying with the laws and regulations, their operating license may be revoked. And when they are not a going concern, they should prepare the financial statements on the breakup basis. So maybe they are not a going concern and still they have prepared the financial statement on the going concern basis. So the auditor should remain skeptical throughout the audit because the auditor responsibility differ in two ways. First, if the material misstatement, if the non-compliance constitutes a material misstatement within the financial statements, and the non-compliance can affect the trading ability of the organization. So what are the audit procedures the auditor needs to apply in terms of the laws and regulation? Now, the first and obvious procedure is that the auditor should take the detailed understanding of the entity and their respected laws and regulation, related laws and regulation. For example, if your client is a financial institution, then you should know the laws and regulations related to the financial institution. If it is a manufacturing entity, then related to that. Similarly, service industries. And inspect the correspondence with the relevant licensing and regulatory authorities. For example, if they're not complying and the regulatory authority have issued them any notification, so see what communication is going between them, because that is going to give you an additional evidence. Inquire from the management whether they are complying with the laws and regulation. Remain alert to see any possible non-compliances, and obtain written representation that the directors have disclosed all instances of known and possible non-compliance to the auditor. So these are the specific audit procedures. You have to learn it. Examiner may ask you in the knowledge-based elements. So these are these two parts and these two, you can say, questions. The first one related to the auditor responsibility in relation to the fraud, and the second one is auditor responsibility in relation to the laws and regulations are very important for the FAT exam. All right, now we are discussing the analytical procedures. Now we have already made a discussion on it when we were discussing the risk assessment procedures. Analytical procedures are used to detect unusual changes within the financial statement. And I gave you certain example at that stage. Unusual changes. Now, I give an example that if the sale is increasing, the cost of sale should increase as well. If the sale is static, then that means, if the cost of sale is static, then that means sales may be overstated. If the PPE is increasing, the depreciation should increase as well. So if the depreciation is static, then that means PPE may be overstated. Depreciation may be understated. And similarly, when the loans are increasing, there should be an increase in the finance cost. So if the finance cost is static, then that means the finance cost may be understated. Now, how we are establishing this relation? How we are establishing this relation? This is known as the analytical procedures. Let's assume I come to class and a student says, "Sir, are you good? Are you feeling good today? I think you're not feeling well." Now, how that student came to know that I'm not feeling well? Because he compared my usual face with the today's face. And my today's face doesn't look fresh at all. That's why he called and said that whether I am feeling well or not. Now, this is what he has done is the analytical procedure. He compared my routine and the regular face with the today's face. So analytical procedure are in the form of the comparisons, in the form of trends, in the form of the ratios. For example, comparing this year depreciation with the previous year, comparing receivable days with the previous year receivable days, comparing this entity's receivable days with another entity in this market. and calculating ratios, trends. All of these are the example of the analytical procedures. So analytical procedures are used at the 3 stages of the audit: at the planning stage for risk assessment, at the substantive testing stage for gathering the evidence, and at the review stage. So this is very important to understand that APs are used at 3 stages: at the planning stage for risk assessment, evidence stage for collecting evidence as a substantive procedure, and then the third thing is on the review stage. Now in term and final audit, we have already made a discussion on that. The audit that takes place before the year end is known as the interim audit, and the rest is the final audit. So usually we do not have the financial statement before the year end, so we can perform the work which is unrelated to the financial statement, such as planning the audit, making audit strategy, making audit plan, taking understanding of the entity, assessing the client's internal control system. These things can be done without financial statements. And then we have the final audit, which includes stock takes, which include reviews, substantive testing, and everything. Whatever we are doing within the audit should be documented. Everything will be documented. There are certain benefits of the documentation, which is important for the exam. You should learn it. Provides evidence of the auditor's basis for the conclusion, that we are not giving a blind opinion. See, you can see everything is documented. We have gathered the evidence. Provides evidence the audit was planned and performed in accordance with ISAs. That means the quality audit has been done. Assess the engagement team to plan and perform the audit. Like, for example, if I'm the new one to the audit and I didn't know what to do, I can see the previous year audit file. Whatever is done, I can re-perform all those things and the audit will be done. Assessed member of the engagement team responsible for the supervision to direct, supervise, and review the work, because everything is documented. So you will know who has prepared it, who has reviewed it. There will be no blame game. So these are the benefits of the documentation. And we are not going to record evidence on a plain paper. That is going to be a standardized working paper in which there will be a lot of things: name of the client, year end date, subject, who prepared it, who reviewed it, on what date it is prepared. So everything will be there. Then there are 2 types of the audit files. Like, for example, if we are doing a recurring audit, every year we are doing the same audit client. Now there is no need to ask for certain documents every year. And those documents which never change, for example, the articles of association, the memorandums of associations, lease agreements, loan agreements, which are long-term, and they usually doesn't change. Group structure, for example, organization structure, usually their accounting policies, things like that. So things which do not change every year. We can take a copy of that and we can place that in our permanent audit file, so that you do not ask for it every year. But if there's any change, if anything is revised, you have to revise your permanent audit file as well. Now coming towards the file of every year, which will be having evidence of the current year from planning section till end, that is known as the current audit file. And standardized working papers, like usually nowadays, the firm has the formats and they use the same formats throughout the audit for multiple audit clients using the same audit formats, same things. That is known as a standardized working paper. Usually the entity firms are having the audit softwares in which everything is standardized. Does it help? Yes, there are advantages. Much easier to prepare, can help in training junior staff quicker. It ensures the quality, but there are disadvantages as well. For example, no incentive for thinking themselves. For example, if I can do something better than this worksheet which is being given to me, I cannot, because I have to follow the standardized document. If there is mistake in one document, that will be transformed to every document. And the clients are different. So sometimes the tailoring thing is difficult. For example, if you have a standardized document, so service industry different from manufacturing, manufacturing is different from trading. So sometimes coping up with the tailoring thing is not easy work to do. So this is all about the planning theory, and you have to learn these things so that if the examiner is testing, you may get easy and absolute marks.